There are several mistakes that can be made when converting money to a Roth IRA, but there's one big miscalculation that happens, and we want to help you avoid it, and that is the failure to set aside cash to cover the taxes. A Roth conversion should be understood to be a taxable event. Why? Because it is taking money that has never been taxed and intentionally moving it to an account that is funded with after-tax dollars. In this case, a Roth IRA. Simply put, a Roth account must be funded with after-tax money. So in order to get the money from a pre-tax status in a traditional IRA or 401k to an after-tax status in a Roth, it has to flow through the tax filter, so to speak. I know this is pretty basic Roth stuff and you probably already know this. However, not everyone adequately prepares themselves to pay the taxes on such a conversion. Here at Strategic Estate Planning Services, when we talk to our clients about paying the taxes on Roth conversions, here is the typical way we approach it. After calculating the desired Roth conversion amount, we then estimate the taxes that will be due based on their marginal bracket. With that estimate in mind, we ask them something like, from what account do you intend to pay this tax? What we're hoping to hear is, we want to hear them say something like, well, from my savings account or checking account. If that is the case, then we want to know approximately what amount of money will remain in the checking or savings after the taxes have been paid. Why are we going through this with them? It's because we want to know about their cash reserve or their emergency bucket, so to speak. We are trying to avoid a situation where they will pull money from their bank account to pay taxes on the conversion and then not leave themselves enough cushion for short-term needs. Or perhaps worse, before they send the tax to the IRS, an emergency comes up and they end up using the money that was earmarked for taxes, and now they don't have it when it's due. Having enough money in the bank to cover the taxes and having a sufficient reserve left after the taxes are paid is what we are hoping to achieve. But what if they tell us they don't have the estimated taxes set aside in a checking or savings account? There are only a few other sources from which the taxes can be paid, but all of these are less favorable, in my opinion, than the one that I just described, where they simply use cash from a bank account that has already been taxed. Nevertheless, the ideal isn't always the way it plays out, so here are some other ways this can be done. Other assets or investments can be sold to raise the cash to pay the tax. This can be acceptable, perhaps even preferable, but the timing has to be just right. Here are two quick examples of how this could go wrong, and they illustrate my hesitation to encourage this route with our clients. So first, what if they intend to sell a parcel of land to raise the cash, but the sale falls through, or it doesn't bring as much money as expected? Also, the sale of the property may be a taxable event as well. So now there are taxes due on the money raised to pay taxes due on the Roth conversion. All right, the second example is, what if they intend to simply sell shares of a stock or some mutual fund or bond they are holding in a non-qualified account, but the share price plummets in value before they are sold? And here too, you have the taxes due from the sale of the shares if those shares are sold at a gain. That's one way, but it has some potential problems. Another potential source of money to pay the tax due is from another IRA account or qualified account. So here's what this might look like. Let's say Jill, who we estimate to be in the 22% tax bracket, has $222,000 in her traditional IRA account. And she has decided to convert $100,000 to a Roth, leaving $122,000 in her traditional IRA account. When the IRS comes around looking for that $22,000 she owes due to the $100,000 tax or Roth conversion, she decides to pull the $22,000 from her traditional IRA, thinking perhaps I'll have $100,000 in my Roth and $100,000 left in my traditional IRA. Perfect. Now, what has she not accounted for in this scenario? Come on, I know you're smart. You probably saw this problem coming. She will now owe taxes on the $22,000 withdrawal as well as on the $100,000 conversion. Now, granted, 22% of $22,000 is only $4,840, and she may have that amount in the bank to cover it. But this method undermines the compounding potential in her traditional IRA. But even worse, if her calculations didn't account for that additional $22,000 of taxable income, she may have put herself in a higher tax bracket and even triggered IRMA on her Medicare premiums. What a mess, just because she misunderstood how to pay the taxes. The last source to cover the taxes on a converted amount is from the conversion itself. One simply has to ask the account custodian to withhold the percentage of estimated taxes in the process of the conversion. Let's say that Chuck wants to pay the $22,000 from a $100,000 Roth conversion. The IRS allows this and actually makes it very easy. However, instead of having $100,000 in his Roth that will have the potential to for compounded growth, Chuck starts off with only $78,000. This means his Roth account will need to grow by 29% before he is back to that $100,000 mark. And this could take years to recover what he paid in taxes. Again, this is a legitimate method of converting covering the taxes on a conversion, but I think it's certainly less than ideal. If you are considering a Roth conversion, you must be prepared to pay the taxes. Simply put, do yourself a favor and have after-tax dollars set aside in a cash-like account, and be sure to have enough in reserve for savings or for emergencies and whatnot after the taxes are paid. If you'd like to explore this topic or other financial matters with our team, give us a call and set up a time for us to visit with you. We appreciate it if you subscribe to our channel, where you can get easy access to many other helpful videos. Remember, when it comes to your money, it pays to be strategic.